Some people who bought Amazon in 1997 became millionaires. Some people who bought Tesla in 2010 became millionaires. And right now, millions of people are staring at SpaceX, wondering if they are looking at the next one. That feeling you have right now, that is exactly what people felt about every stock that made some people rich and destroyed everyone else. Because here is what nobody tells you. For every Amazon, there are thousands of stocks that looked exactly the same at the time and went to zero. The math on single stock investing is far more brutal than the stories you hear about it. And SpaceX, the biggest IPO in history, is now publicly traded. So the question everyone is really asking right now is not whether SpaceX is exciting. The question is whether betting on a single stock, any single stock, is actually how wealth gets built.
SpaceX is currently preparing for what's expected to be the largest IPO in history, with a target valuation as high as $1.75 trillion. To put that in perspective, that's larger than Meta or Tesla.
This company just had a very successful Computex festival in Taiwan.
But there's a lot you should know before buying in.
The answer is going to surprise you. SpaceX was priced at $135 a share in its IPO and opened trading at $150 on its debut day. Within days of listing, the stock had already surged well above its IPO price. The company raised $75 billion in its IPO. Elon Musk is now officially the world's first trillionaire.
Elon Musk is the first trillionaire in human history. Just minutes ago, SpaceX began trading and immediately jumped by more than 20%.
On the surface, this looks less like a bet and more like a boarding pass. The plane is already on the runway, you just need to get on. But before you open your brokerage app, there is one number that should stop you completely. Over a 90-year period, just 4% of stocks generated every single dollar of net wealth the stock market has ever created. The other 96% either underperformed a basic savings account or lost money outright. Not some of the gains, all of them, from 1 century of investing, 4%. If someone handed you a bag of 100 lottery tickets and told you 96 of them pay out less than a savings account, you would not call that investing. You would call that gambling with extra steps. Now here is where it gets worse. From 2000 to 2020, only about 22% of S&P 500 stocks outperformed the index itself. The median stock gained roughly 63%, while the index gained about 322%. The average stock most people would have picked returned less than a fifth of what simply owning everything would have returned. Apple, Amazon, Tesla, Nvidia, Meta, Microsoft, Alphabet. 7 companies created roughly $20.6 trillion in shareholder value over the last decade. 3/4 of all the wealth generated by the top 15 stocks combined came from 7 names. Those are the 4%. And here is what nobody says out loud. In the year each of them went public, there were hundreds of other companies that looked exactly the same. Same excitement, same inevitability, same feeling that missing it would be a mistake you would regret forever.
DoorDash, Snowflake, which saw an over 100% gain on its first day of trade, underperformed 6 months later. Now that's no guarantee of how SpaceX will perform. There's lockup expirations, the path to profitability, and other market dynamics.
Most of those companies no longer exist. SpaceX could absolutely be the next name on that list. The rocket reusability, the Starlink revenue, the scale of the ambition, none of that is fiction, but could be and are separated by a gap that has swallowed fortunes. And if you think the professionals do better at spotting that gap, over a recent 20-year period, 91% of professional fund managers underperformed the S&P 500. People with research teams, Bloomberg terminals, and decades of experience. 91% still lost to the index. So the excitement around SpaceX is real. The 19% debut day gain is real. But excitement has never been a selection criterion, and even if you somehow pick the right stock, the structure of the trade itself can still destroy you. Here is a question worth sitting with. If SpaceX had gone public in 2002, the same year it was founded, before a single rocket ever launched successfully, would you have bought it? Because that is exactly the position investors were in with Amazon in 1997. It was a fast-growing online bookstore that was still losing money and viewed as highly risky. Most people passed. Drop in the comments, what is the one stock you always wished you had bought and held forever? Because what happens to most people who get in on day one of a historic IPO is not what you think.
SpaceX IPO in the final stages before making its debut.
Bankers here at Morgan Stanley and Goldman Sachs and the other book runners are calling hundreds of investors and letting them know how much stock they'll receive out of what they requested.
Opens at $150. That is an 11% increase on $135 pricing.
Assume you are right about SpaceX. Assume it becomes the next Apple. Apple's stock grew more than 15,000% over the last 20 years. A $10,000 investment in 2006 would be worth roughly $1.5 million today. That is the number people remember. Here is the number they forget. Apple dropped more than 30% at least 4 separate times during that run. Each time the headline said it was over. The iPhone was losing market share. Tim Cook was the wrong CEO. China was going to kill the business. The math only works if you never flinch. Most people flinch. Now here is something most retail investors do not know about SpaceX specifically. Some employees and early investors may be able to sell portions of their holdings earlier than many traditional IPOs allow. Most IPOs lock insiders out for a full 180 days. SpaceX is not doing that. The people who know this company better than anyone on the outside will have the option to cash out before most retail investors have even decided whether to hold. And when you look at the actual financials, the picture gets more complicated. SpaceX generated $18.7 billion in revenue last year. Despite massive revenue growth, SpaceX is still not consistently profitable. You are not buying a profitable company. You're buying a story about what the future could look like. Stories can be right. Stories can also be catastrophically wrong. Here is what that looks like in your brokerage account. If SpaceX drops 30% shortly after its IPO, you are sitting at roughly $124 a share, below the IPO price of $135. You have lost money on what everyone called the trade of the decade. A 30% drawdown is not a disaster scenario. It is a completely normal event in the life of a high-growth stock. Apple went through it 4 times on the way to a 15,000% return. The question is not whether SpaceX can survive a 30% drop. The question is whether you can. But notice what that also means. If SpaceX joins the NASDAQ 100, you can own it through a simple index fund without making a single stock bet at all. You get the upside. You skip the concentration risk. The index does the picking for you. And that is where this question stops being about SpaceX and starts being about something much bigger. Because the real question is not whether a single stock can make you rich. The real question is what actually happens to the people who try. Meet Mark. Mark is not a reckless person. He is a 44-year-old engineer who has been investing since his late 20s. He reads earnings reports. He follows the news. In the year 2000, he looked at Cisco systems and saw exactly what everyone else saw. The backbone of the internet. The infrastructure that every business on Earth was going to need. The analysts were unanimous. The growth was undeniable. The opportunity felt obvious. Mark put $80,000 into Cisco, most of his retirement savings at the time. Cisco stock has still not returned to its year 2000 high. 26 years later, Mark did not lose everything, but he lost years. He spent the better part of a decade watching a stock that was supposed to change his life slowly drain the financial foundation he had spent his 30s building. And while he waited for a recovery that never fully came, the S&P 500 kept compounding without him. That is the cost nobody puts in a spreadsheet. It is not just the money you lose if you are wrong, it is the years you lose waiting to find out. If you invest $50,000 in a single stock and it drops 50%, you need a 100% gain just to get back to where you started. While you're waiting for that recovery, the index keeps compounding. Every year you spend underwater is a year the market is widening the gap between where you are and where you could have been. Investors have a name for this. They call it opportunity cost. And it is invisible until it is devastating. Now here is where it gets genuinely interesting. Nobody is saying you have to choose between owning the index and owning a single stock. Most serious long-term investors operate with what is sometimes called a core and satellite approach. The core, somewhere between 80% and 90% of the portfolio, sits in broad index funds. It compounds quietly. It captures the 4% without requiring you to find them. The satellite, the remaining 10% to 20%, is where you take your conviction bets. SpaceX. A sector you understand deeply. A company you have followed for years and genuinely believe in. This is how you get exposure to the upside of a single stock, without betting your financial future on being right. If SpaceX becomes the next Apple, that 10% position turns your portfolio into something extraordinary. If SpaceX becomes the next Cisco, your core is still compounding and your financial future is still intact. The people who actually got rich from Amazon and Apple were not usually people who put everything into one stock and held on pure faith through 30% drawdowns and years of doubt. Most of them had a foundation that was already working, and Amazon or Apple was the bet on top of it. That is the version of this story that never makes the headlines, because it is not dramatic enough, but it is the one that actually works. So can a single stock actually make you rich? Yes, absolutely yes. Amazon did it. Apple did it. Tesla did it, and SpaceX might do it for the next generation of investors who buy today and hold through every crash, every headline, and every moment of doubt over the next 20 years. But here is the honest answer nobody wants to say out loud. The people you hear about, the ones who got rich from a single stock, are the survivors. You do not hear from the thousands of people who made the exact same bet on a company that looked just as inevitable and watched it go to zero. Survivorship bias is the most expensive blind spot in investing. The strategy that has actually built more wealth for more ordinary people than any single stock in history is not exciting. It does not make for a good story at dinner. It will never go viral. It is owning everything, every sector, every company, the winners and the losers. Because the 4% that create all the gains are already inside the index, and you do not have to be smart enough to find them before everyone else does. SpaceX might be generational. It genuinely might be. But the question was never whether SpaceX is worth believing in. The question is whether you need to be right about SpaceX to win. And the answer to that is no. Every week on this channel, we take the financial decisions most people make on autopilot and ask whether they are actually worth it. If that sounds like something you want, you know what to do.